Good evening, everyone. My name's Aria. I'm Head of Policy at the Entrepreneurs Network, and I'll be chairing the event tonight. On my left, I have Patrick Newton, the founder of Form Ventures, an investment firm, and Daniel Robinson, who works on the research team at Bowhurst. So should we start off, first of all, with some comments from you, Dan, about what your research is finding about the state of entrepreneurship in the UK today?
Yeah, of course. So Bowhurst is a database of high-growth UK companies and businesses that have high-growth potential. So these are businesses that are either growing very, very rapidly or we think have the potential to do so. So the way we identify these businesses is using 8 triggers, ranging from equity investment, spinning out of a university, to undergoing a management buy-in or a management buyout. Obviously, tonight, the equity investment piece is really, really interesting. So I've gone through and tried to find some stats for us to talk about. And I guess the big headline one is that in 2022 so far, companies have raised 22 billion via nearly 6,000 deals. So really a very substantial amount of money going into private UK businesses. Actually, it's their second highest figure on record. Last year was the record with, I think, 28 billion via nearly 7,000 deals. So really a lot of money flowing into this part of the market at the moment.
A quick question. How does this compare to inflation? Because every year you see that there's more and more investment in the UK startups, but I don't know if that is just tracking in, inflation or if the UK startup scene is growing faster than that.
So we've been at it since 2011, and it has pretty uniformly kind of grown over that time. 2020 was a bit more stable, and then 2022, although it is kind of the second highest year on record, is kind of pulling back from those highs of 2021. So it's certainly expanding as the ecosystem itself kind of matures. But we are seeing more and more money being invested as well. So the ability of firms to take in like increasingly large amounts of capital has increased dramatically. When we first got going in 2011 or 2012, you wouldn't expect to see a company raising 50 or 100 million from private investors. You would have to go IPO for that, and now it's kind of a fairly common occurrence.
Okay, so what are we seeing? What are the stats we're seeing?
So I guess I was trying to set it up by talking about how 2022 was really impressive. A bit of a decline from 2021, but actually the kind of the bad news here is the way that it's been distributed over the year. So Q1 was very good, 8.3 billion. Q2, 7 billion. Q3, this is where things really start to drop off, 4 billion, and then now 2.7 billion. I imagine we'll probably end up maybe around the 3 mark. So 70% of investment this year kind of fell into the first half of the year. So unfortunately, there has been quite a kind of dramatic fall off since that point.
And Patrick, do you want to say a little bit about what Form does and then see whether or not you're also seeing these kind of reductions?
Yeah, hi everyone, I'm Patrick. So I founded a pre-seed and seed fund focusing on, we call it the future of regulated markets, so either traditional regulated markets or new markets that will be regulated, like cultivated meat or carbon offsets. So I mean, we invest in about 10 companies a year, I should say. We're investing in a second fund at the moment of 30 million. And yeah, I mean, that reflects what we've seen. So a slowdown in deal. I guess we're at the earliest stage. So we're seeing a slowdown in deal flow, although I suspect what's actually happening in the numbers is you're seeing more of a slowdown at the growth stage, which are the really, really big rounds that a lot of people, we were told, in fact, it affected some of our portfolio. The bigger funds were like basically taking the whole summer off. What seemed to be happening was that as the market turned down, everyone had invested at crazy valuations in 2021. People decided there's going to be a retrenchment of capital. We need to secure your own portfolio. And then if everyone's securing their own portfolio, the only startups that are coming to market are the bad ones. Or that was what the mentality of lots of growth investors was. So no one was looking at new deals. And it just meant so you were kind of hoping you could get capital from your existing investors. If you didn't, then there was a real struggle in the market. So those big rounds that we saw in 2021, often led by US money, like they were pulling back. And I think it's been a pretty brutal year for a lot of founders. And then as I was saying, a slightly different story at the earlier stage. It's just capital has slowed down. Like investors are being a bit more careful. But there's also, I think there's also is an interesting. I mean, what we will see, I think, is the cost of living is. I think not many people seem to be focused on the fact that cost of living is going to make founding a company like a really unappealing thing to do. Maybe we'll get onto the female founders point, but I'm sure what we will see is fewer startups being built, despite some VCs saying it's the best time to build a startup. I think it may be in terms of best time to invest in startups from a VC perspective, and like previous downturns have shown that. But founding a company when there's a cost of living crisis is pretty tough, except for people who are very financially secure. So I expect we'll see that in the next couple of years.
So what would be your advice to startups? I guess let's go from the very early stage now. If you are like looking to found a business in this economic climate, like what kind of sectors is it better to look at? What kind of funds is it better to look at?
Well, I mean, I have a bias. So our view is, in general, more highly regulated businesses, yeah, there's more of an acceptance for them taking longer, but also they rely less on discretionary spend in general. So things like healthcare, people will continue spending money on health during a downturn. So and obviously that's the same with financial services. So we have a bit of a bias that I would say that those sectors are good places to, and very often, in my view, meaningful sectors to be building businesses in. Sorry, the second part of your question was not just sectors, but
just like what other advice do you have? Like what are the obvious things from
in terms of funds and I think as always doing a lot of engagement with funds early and engagement with people there, like this is kind of really well worn stuff, but the agile testing your idea a lot with people before you kind of make the leap. Just because it's a really tough fundraising environment, so you want to start fundraising when you're ready. Because I think one of the things that people don't realize is you can although you want to reach out early, you also can burn bridges by like testing something that's not quite ready to be discussed with an investor. So just doing a lot of basically pre-work before you try to raise money, because, and again, that's going to be hard for people who can't financially afford it, but the reality is people are expecting you to be further along now. So 2021, you go out to market with an idea, and like people would give you a few $100K to kind of test it, and that's just not happening now.
Right, I see, that makes sense. What are you finding from the Bohurst data about which sectors or areas aren't getting as punished as much by the current economy?
Well, just to flip it on its head slightly, I can let you know about which ones are certainly being punished, and then people could maybe try to avoid those, I guess. So I had to look at the kind of proportional breakdown of deals by sector, seeing kind of what sort of decline in real numbers and kind of proportionally we've seen. And the worst was leisure and entertainment. So there were 307 deals last year into these businesses. That's down to 174 so far this year. So really quite dramatic. That's about 43% decline for those businesses. So, if you're thinking of starting a leisure and entertainment business, it might be a bit more of a challenging environment at the moment. Another one that wasn't looking particularly good, in fact, looking a bit worse, was media. So again, from 248 businesses, now down to 133 that have, deals, not businesses. So yeah, quite dramatic there as well. A few that are kind of looking a bit better, so sort of roughly kind of line up with what we're seeing like overall in the market. Business and professional services, so that's kind of down, 27%. Tech, 33% fewer deals. One that actually surprised me quite a lot is retail, down 23%, not quite as dramatic as I thought. And then one that seems to be, at least in kind of the total deal proportional breakdown, is supply chain businesses. So it is a kind of a slight decrease in the overall number of deals, but in the actual total mix of funding, those businesses, are kind of, securing more deals among their peers. So yeah, so a bit of a mixed bag there.
Yeah, to me, it sounds like that's a general cutting back of luxury investments, and that kind of draws on what you said about how like healthcare is a likely place that like won't be affected by the crisis. Okay, should we go to the audience and see if anyone's got any questions for our panelists?
Hi there, really interesting talk so far. One thing that I wanted to pick up on was, Dan, you were saying that we had a reasonable amount of investment in Q1 and Q2, and then it kind of dropped off in Q3 and Q4. Are there kind of any reasons for that? Is that kind of a cultural thing? Does that sort of normally happen on a year-to-year basis, or was there something particular about this year that you think caused that?
I've kind of thought I might be asked something a bit like this, sort of put together a few thoughts. I mean, really, like there's a lot of different factors, I think. The environment has changed really dramatically this year. You know, a lot of that crazy investment that we saw in 2021 was driven by, you know, the unprecedented stimulus around the world, people moving into riskier and riskier assets. And now, you know, coming out of lockdowns, people are less kind of locked into technology. Some of those businesses are certainly going to come off the boil and start to look a bit less attractive. Obviously, war in Ukraine, the energy crisis, supply chain, all of these things potentially kind of, I guess, impact how investors might be thinking. You know, they still have a mandate to deploy their funds, but perhaps particularly at the very early stages where you have more discretionary angel investing, people can kind of turn off the tap more quickly when you have these more challenging environments. Something that may be a factor here as well that we struggle to have sight on is the use of convertible notes. So I guess in a more uncertain environment, instead of you know, putting the money in directly, actually you might use a convertible note. It's kind of something that anecdotally people seem to do during the pandemic as well, and perhaps something maybe, Patrick, you know a bit about.
Yeah, yeah, I guess actually famously that happened with Peter Thiel and Facebook. And yeah, it's in periods of greater uncertainty, well, you can move very, very quickly because you don't have to negotiate all your terms. And in periods of uncertainty, it's just a way to get cash in quickly. You often aren't, as you say, they're not announced, so you don't see them. This is a good thing to do when you're like, maybe you're not in a position, it's not a great PR splash, you want to raise through a note like that. I think it's, you know, they can be, certainly from the founder angle, can be attractive. Just to add to the, I guess the points about what caused it to come down this year, the public markets obviously in January just absolutely tanked, in particular on tech, and tech has like done incredibly badly this year. And I think someone did some analysis looking at the last two downturns and how long it took for public market prices to kind of come down to the earlier stage, and it was basically a full 12 months before seed valuations were corrected for what was happening in the public market. So by those measures, it's going to be like, it's around now that things have, like in our view, prices have been coming down slowly in seed during the year, but like nowhere near to the degree that the tech stocks have been like hit. So, you know, now is probably a time. This is why, as I said before, a lot of investors are saying it's a great time to invest because 2021, you know, the power dynamic was so much tilted towards founders, and now it's tilted back the other way. And actually, we've started to see some pretty bad behavior from some funds as a result because, you know, when given the power, certain people don't behave in the best way.
That makes sense. Is this now, like, if there's like slightly less investment going into companies, are we now seeing better things come from, I'm like asking you, but you may not have looked into the numbers, from government grants and other similar things? Are we finding more founders are moving over to those options? Or like, you know, there are lots of options that aren't private equity investment.
Yeah, I guess the other thing that Bowhurst is really focused on is grants. To be honest, I've not really looked at it too deeply in preparation for this. I don't think the numbers will be kind of dramatically different from what we'd expect in any other year. The government did kind of give out extraordinary grants during 2021 to help, you know, kind of IP-rich businesses to survive the pandemic, and particularly at the early stage. But I don't think we're necessarily seeing that sort of activity at the moment. So. Sorry.
Oh no, sorry. I was just going to. It's interesting. Maybe this is very much anecdotal. It's driven by like companies that we've been interacting with. But in general, during 2021, when there was just so much venture money in the market, lots of people who were previously just software investors were looking at other sectors because there was a crowding out essentially in pure software. So they're looking at biotech. They were looking at hardware, which are sectors that usually, like a lot of software VCs say, like we really don't want to look at these markets. in 2022 that's like completely reversed. And I think we're seeing that play out in terms of effect on grants, because deep tech investors who were like getting lots of attention, I say deep tech, so kind of novel, new technology that was receiving lots of attention in 2021 from VCs, suddenly they're left like needing to raise money, and a lot of VCs have kind of returned to their pure software and kind of tried and tested technology focus. So then, like, the number of conversations we've had about Innovate UK in the last few months is like more than ever before. So we have a note that we send out, like, because it's really, and as everyone knows, that sometimes it can be hard to find exactly where you find grants. And yeah, there's a lot of founders doing really, really great work that are struggling to raise money, so leaning on those grants a lot. So maybe it'll come through in the data like in a few years, but it's really, really important that's like filling a gap now.
So I guess other than not have a recession, what would you say that you'd like to see the government doing in order to like turn like a lot of this around?
I can't speak to it in a really expert way, but I do think some of the things around the R&D tax credit scheme are interesting and maybe a bit concerning as well for a lot of businesses that are kind of, IP-rich businesses. I do kind of understand the feeling that perhaps there was some people perhaps misusing that scheme, maybe to understate things slightly. But then at the same time, that is a vitally important scheme that gets money out to really innovative, interesting businesses. And to see that kind of turned off would be a real shame, I think.
Yeah, I mean, definitely. And well, we're hoping that was kind of a bit of an oversight rather than like a deliberate play, because it seems to be, at least with a segment of early stage founders, it's like united everyone in a cause, which is quite impressive. I guess on the kind of general startup market, we've been doing just a bit of work to look at like different startup policies across Europe, and the UK is pretty good, and the EIS and SEIS, obviously there was a tweet to SEIS. Like they are, in our view, pretty generous schemes and do pretty well to get money flowing in at the earliest stage. And that's reflected in when we looked at other European countries, no one else seems to be. As I think the Dutch have a scheme which supports VC funds. In the UK, that comes through the British Business Bank, which has a great program. I guess from our perspective, there should be more of a focus on vertical, where technology is hitting like verticals. So like, how is it affecting childcare? How is it affecting cultivated meat? How is it affecting like this? There should be a renewed focus on basically across every sector. How can technology drive growth? Because often it's just seen as like, oh, there's something that is like cross-cutting, but we shouldn't be discussing it in the context of each government department. So there's quite a lot to be done, I think, to change that mindset.
That makes sense. Any other questions from the audience?
Thank you. This is for you, Patrick. So you're working in more the regulated space, and that clearly is implying a number of hoops that companies need to jump through. So I'm wondering what advice you're giving to companies in terms of their fundraising needs and the burn rate in order to ensure that they can actually get compliance before their product can come to market. But then by extension, and this touches on your last remark there, are you seeing the UK comparatively better or worse over the past year in that regulated space?
Oh, interesting. I think, so we usually advise, especially at the moment, trying to raise 24 months runway to give yourself enough time. Obviously, there's two different approaches with like that type of licensing. Some people think if you can get away with it for long enough outside the regulatory perimeter, then like take that approach. And the way we view it, and as the other side is obviously like engage early and get like fully regulated early on. Obviously, this differs in different markets, but there's a general kind of bifurcation between like those two groups. Our view is, as long as you're like very deliberate and strategic, and you can justify which approach to take, then you can arrive at the right answer, and they can be in either camp. I think, I mean, how long it takes, how good we are. Like, I think the FCA in the past has been held up by regulators, certainly in the Far East, as being really, really strong. I think there's been some transformation programs, and maybe it's not quite the focus it was between 2010 and 2015. So I'm unsure. This is a very, very anecdotal, but I'm unsure whether it's quite as like fast or I think. And they've had like a large crypto backlog, which I think has probably made it quite difficult. And it's a pity it hasn't really come across into like other sectors. There's a focus on software as a medical device at the moment. Like basically, how do you regulate medical devices that are like AI or software driven? That is like it's quite late in the day to be talking about it, and it needs to. That's like one particular area that comes up a lot when we talk to health companies. But that's a problem everywhere across Europe that now the UK is having to deal with, obviously slightly separately to the EU. So I guess I don't think anyone is particularly good at that. And in fact, one of the reasons that we invest in this area is because we think Silicon Valley isn't actually necessarily the best place to be building regulated startups, because they're like move fast, break things. We're all just building something in a garage. It's not necessarily the best way to build healthcare companies or companies that, you know, when something goes wrong, a consumer gets hurt. Like maybe not the best place to be building those companies. So we think the UK and Europe can have a bit of an edge in that area.
Julie, would you like to introduce yourself?
Yes, so I'm Julia Elliott-Brown. I am the founder and CEO of Enter the Arena. We are a coaching and advisory business that support high-growth female founders with raising investment and business growth. I've been in the startup industry for about 25 years, a serial entrepreneur myself. So I've been in your shoes. I've raised millions of pounds for my previous business. I've been doing this for 7 years. And all we do day in, day out is support founders with raising investment and scaling.
So we've had I'm going to say, a slightly pessimistic conversation about the current state of UK startup investment. What have you been seeing? What have you been like coaching your entrepreneurs on about like how to deal with the current environment?
I think we have to be careful not to get too negative about this, because it's not very helpful for entrepreneurs who are trying to build their businesses. There are some challenges. We know how much investment has dropped since this time last year. And I think that can be challenging, particularly when you're at the start of the fundraising journey. Investors might be putting more of their money into later stage businesses, into their existing portfolio. But a couple of things that I think can work in founders' favour at the moment. One is that there's been an adjustment in valuations, which I think is a good thing, because they were becoming perhaps a little bit overheated. And if we have a more sensible valuation when we raise money, we are much more likely to satisfy our investors' requirements in return in generating return on investment as we grow, because we've not overpriced the business at the start. So I think that that's quite a positive thing. And I think it really focuses the mind on those businesses that are going to really make a difference in the world over the longer term. It flushes out those businesses that perhaps are going to get more affected by the cost of living, that perhaps don't have a really unique point of difference. And sometimes I think, again, that's not a bad thing. There are some businesses that perhaps shouldn't get funded, if that makes sense.
Yeah.
So it focuses the mind on those businesses that are really making a difference. And, you know, only the best will get funded, and that's right.
And so you focus on helping female founders. What is your advice to female entrepreneurs who are raising, over the next few months?
I suppose quite similar to the advice about not letting the state of the economy pull us down. I'm sure many of you are aware, you hear all the stats about how challenging it can be for female founders, and we hear how little money goes to female founders, but we have to be very careful not to let those statistics again become a self-fulfilling prophecy. Because if we do that as a female founder and we go into fundraising expecting to experience gender bias, expecting to have problems, we will manifest those problems. So I think we have to go into fundraising with a positive mindset, with confidence, but we have to upskill ourselves as female founders to make sure that we can go out there and smash it in what is still a very male-dominated world, I'm afraid to say.
Yeah. And you've got a new book coming out. Could you give us the pitch, the blurb, the exec summary?
Yes. My book is already out. It's called Raise, The Female Founder's Guide to Securing Investment. The reason I wrote this book, there's many reasons actually, but the main one was that as an entrepreneur myself, when I was out there trying to raise investment, I bought loads of different books about how to go about it. But to be honest with you, they were all pretty much written by men, mostly from Silicon Valley, coming at it from a very technical perspective and very focused on VC. And they just did not speak to me as a female founder in the language that I understood, with the experiences that I was facing and the challenges I was having to overcome. Understanding what it is like as a female founder, trying to juggle and balance, it didn't speak to me at all. And I felt there was a real gap in the market, and I wanted to write something that supported female founders in knowing how to overcome those challenges, understanding how to navigate this world in a really straightforward and actionable way, rather than being super confusing with lots of complicated language. I think there's a lot of that out there. And usually when people are using really complicated language, it's unnecessary. It's really unnecessary. And I also wanted to showcase over 35 amazing female founders that I know that have raised investment, many of whom I've worked with, many of whom I've interviewed on my podcast, to, again, show women out there that there are some great female founders who are raising investment, and they've all shared their learnings, their top tips, in a really honest way, which I think is so important. We see all this glossy stuff about fundraising, and you read in the press about so-and-so having done a Series A and a Series B, and there's so much more to it than that, and we need to be more honest, I think, in sharing the real stories of what it's like to raise investment.
Okay.
Great. So I just wanted to kind of follow up on the kind of point around smart money, and whether that's something that Patrick and others on the panel kind of notice, that there's actually a kind of real opportunity for when others retrench, for you guys to kind of step in and really kind of find something that previously perhaps there was more competition for those ideas and for those founders from other investors.
Yeah, I think that's true, and that's why, unfortunately, at the very earliest stage, there's actually still certain deals are still very competitive. So actually, the investors saying, "Oh, valuations are coming down," it is true by and large, but there's still deals that are getting those crazy valuations, and it's just because people take that view, which is oh, actually, if others are retrenching, this is the time to lean in. And at the earlier stages, funds are doing that. And if anything, actually, the growth stage funds are trying to do earlier stage stuff because they think, oh, that's less risk. There's weirdly less risk because I'm putting less money to work. I can go down and play kind of at seed, and it just means actually it's still very, very busy. So yeah, I think we are trying to take that view, but unfortunately everyone else is as well. So from an investor standpoint, basically, it's one of the reasons why valuations are still, they've been, at the beginning of the year, we saw the public markets come down, and then the big rounds went at growth stage, and then really seed valuations have still remained reasonably high until this point. They still haven't gone back to where they were. But when I'm old by venture standards, I started investing in 2015, and Series A then was less than 5 million. Now seed rounds are all, a reasonable seed round seems to be 3 to 5 million now. So yeah, we've still got quite a long way to go for the market to correct, I think. What's your view on that? Do you think it's?
I have no idea. I'd love to predict the future.
Yeah.
I really, and I don't know enough about that to comment. Yeah.
So something I've heard from a few founders that I've talked to is that British valuations are just generally much smaller than American valuations, and that if you really want a big pot of money, you should go over to the States. I don't know if Bowhurst picks up on this sort of thing, but do you find that this is actually the case? And is there going to be more of a divergence between British and American investors, or less of one? Is America also following the same patterns? What are we seeing?
Bowhurst is very focused on the UK, but obviously we think about everything, in the context of the US. I think while we are going to have a bit of a correction, I think over the longer term, we probably will have more convergence in terms of valuations. I think British entrepreneurs probably rightly have a certain expectation that they will kind of seek out in the market. But another factor is that, there is more and more new money coming into the UK. So we can see it in the data. You can see more funds making their first investment in a private UK business every year. and that is growing, the number of funds doing that. So as more money seeks, more companies, but not dramatically more companies, as you have kind of, more kind of, I guess, we have a lot of, US entrepreneurs in the UK as well, with perhaps certain expectations around valuation. And then also funds are raising, more money as well. I think all of these factors will continue to pile in and will maybe not 2021 levels, hopefully, but will continue to kind of lift valuations across the board.
Yeah, it actually goes back to what you were saying about the startups. The good ones will survive, and they're, in a sense, that being a good thing. And that's the case with, in my view, what will happen with funds. More than 10 American funds have opened offices in London in the last kind of 2 years, from NEA, Sequoia, General Atlantic. And that's putting a lot of pressure on the venture market. So you either need to compete to be able to offer those huge rounds, so raise lots and lots of money, or be very, very focused and differentiated. And this kind of, we're just going to, just continue with the same strategy that we had 5 years ago, 10 years ago. I don't think that will cut it. So there's just a lot of pressure on venture funds themselves to basically be able to do well. So I think we'll see. Unfortunately, as people say, it takes a long time to kill a venture fund because they're 10 years long. So if you don't do well, it's like 10 years later. Like, we weren't very good.
I mean, I always get a lot of founders kind of say, should I go to America to raise money? Isn't it going to be easier over there? They take bigger risks. They put a lot more money in at an early stage. I think the reality for most UK-based founders is, unless you're ready to go and launch in America and potentially base yourself there, it can be quite challenging because investors want to be close to their founders. And obviously we have the really great tax breaks here that, I'm talking about early seed stage, It is a great place to raise investment because of those tax breaks. And I think the recent changes that the government have made that did actually stick in the budget, that we can now raise up to 250K, seed enterprise scheme is a really good thing. So, the lure of America, maybe later, once you've kind of done your later stage seed stage round or Series A, then maybe America's calling. But there are always people who are going to go out and break that rule. But generally, I think the UK is a good place to raise.
You talked a lot about investment. Before you arrived, asked about some grants and stuff. But I would like to talk more about access to other kinds of funding. So you've noticed the increase in safe notes. We talked a bit about grants. We talked a little bit about loans as well. What do you if you're looking at non-equity forms of finance? What is your advice to founders?
I think it's always great to get out of the block with a startup loan. I think it's that we shouldn't be afraid of debt. If you're not prepared to take on some debt, then why would you expect investors to back you? I think you have to be prepared to back yourself. So I'm a fan of a startup loan, grants, absolutely. But I think also, as founders, we can try and be more clever with our commercial terms, getting payments up front from our customers, reducing time to pay from suppliers, using things like invoice financing where we can. And for some of those businesses that are a little bit further on, so if you're an e-commerce business and you've got a proven a marketing machine that's working, using kind of venture funds that will pre-fund your e-commerce activity, which I think is quite clever. Not for everybody. But there aren't loads of different sources of finance, really, at the end of the day. And grant finance is not appropriate for everybody. And I speak as someone who is in the process of applying for some grant funding for something else I'm doing. And it's really tough to fill in a grant form, if you've never done it before. That's a whole other world of pain. So I'm seeing more founders kind of taking a really blended approach. I think we all wish we could raise enough money so that we don't have to raise again for another 2 years, but it just doesn't happen. I think as a founder, you have to get your head around the fact that you're kind of constantly raising. And we are seeing more of that kind of rolling closes, kind of, those safe notes, people kind of taking a bit now and then converting it when they do the round. It can be a lot more piecemeal. It can work in your favour because it means you don't sell too much equity when your valuation's low, right? But it, as a founder, it can feel really painful.
Yeah, I mean, lots of the founders I talk to do basically seem like they're constantly raising, which I guess, like you said, there are benefits and drawbacks. So, I asked you to look at a couple of female founder statistics before we started the panel. So, do you have anything to sort of like corroborate what Julia's been saying about like female founders and what they should be thinking?
Yeah, I guess I can talk. I specifically looked at first-time raisers, so I thought this would be something potentially interesting for both Patrick and for Julia. And then I did look specifically at companies where they had at least one female founder. So I can kind of break some of that down, and perhaps we can use that as a bit of a springboard for additional discussion. I guess the reason we often look at this at Bowhurst is because we think it is really important for kind of the future of the high growth economy. This is kind of the pipeline of these really exciting growth businesses. So when you see things start to happen here, it's a bit of an early warning sign. So that's why we look at it quite closely. And 2022 saw 2.3 billion raised via around 1,600 deals. So this was actually the lowest total investment since 2016 and the lowest deals since 2013. So it was around about down 30% kind of on both fronts from last year. So last year we had 3.3 billion via 2,400 deals. So it's not the best picture, I guess. There's around 800 companies, or potentially 800 companies that in other years would have secured equity that have not been able to do so. So not great, really. That might be exacerbated a little bit by how fresh this data is. I kind of was looking at these figures this afternoon. It can take a little bit longer for some of these deals to filter through and for us to capture all of them. But I'd say on the whole, for those people raising equity for the very first time, there's a lot fewer of those. So yeah, that's kind of the overall picture. And I guess I feel like I'm bringing all this gloom, but like the part of the issue there as well is that we can see that the figures are falling off quarter by quarter. So, Q1 was a lot better. It was around 470 deals, then 460 Q2, 370 Q3, so now kind of down around the 200 mark in Q4. So you can kind of see that deal activity is falling away for these very, very early stage businesses. So not brilliant stuff.
So I guess we talked about American companies, investment companies coming here, but I guess like in many ways the world is shrinking. Like people like to be close to their companies, but also you can like video chat with lots of people. They can fly over, they can visit. Are we seeing more UK companies invest abroad? Is that anything that you've seen? Is that anything you're thinking about?
Yeah, in 2021 definitely it became very fashionable for VC funds to invest in emerging markets, and I think there were a couple of very high-profile blow-ups of companies in jurisdictions where, like, a lot of people were making bets or partnering with founders where they didn't really understand the risk profile of what's happening in the country. And I think 2020, along with that, echoing those statistics, I guess, but with non-female founders, and I mentioned this earlier, Julia, just before you arrived, that my view is what we'll see is, unfortunately, a bit of gloom, but with the cost of living crisis, you'll see even more of an overrepresentation of like the most privileged sets of society being able to raise, because others will just face the same hardships of everyone else in the economy. So I think that like retrenchment of money it's basically everyone, the way that it's been described to me is there's like a flight to what people see as quality. And I put it in space because that's just some people's view, but like safe bets against almost every axis. So like they will just focus on high growth margin, pure software, subscription services. Like so, whereas in 2021 there were lots of interesting companies being backed. Now there's just just UK focus. A lot of funds focusing just on the UK, and we do just focus on the UK. That's according to our kind of agreement with our investors. So unfortunately, we couldn't in 2021 actually, even if we wanted to, look abroad. But it's just that I think we're still in the process of that retrenchment, and I do think, unfortunately, those statistics will be echoed and with other segments outside, basically the most privileged people in the market. Sorry, really gloomy.
I've thought of something positive.
I don't see this this is not my inspiring found a company pitch.
I've thought of something positive to say. I think so. Something we do see in the data, and kind of however you cut it, we see that businesses that have women founders do skew younger, and I think my interpretation of that is that we're seeing more and more women entrepreneurs start companies, and that's why they kind of skew young when you look at the overall kind of cohort. And I guess maybe it'd be interesting to talk about perhaps some of the reasons behind that, and perhaps how we can encourage that as well.
Do you think that'll be a cohort effect, that like those people as they get older will will that cohort continue to do it more, or do you think it's unfortunately that will just tail? What's your?
I guess you'd hope so, right?
Yeah.
I hope you get some serial entrepreneurs, but I think perhaps an aspect of it is also role models. People look around and they go, yeah, there's someone like me who started that company. I can do that as well, and hopefully you get kind of a really positive effect, a kind of knock-on effect over time.
Yeah, I would agree with that, actually. I think the younger generation, they have gone through life with probably less of those biases than the older generation has had. So they hadn't had, 20 years to be beaten down by the man. It's the truth of it. They're brought up in a very different way. But there's maybe that bias is still to come. And I think there's an interesting point here when women get to a certain age, of childbearing age, those biases do start to kick in a lot more heavily. But we mustn't forget the average age of the entrepreneur is, 44, something like that? No. I work with some incredible female founders who've come having had super stellar careers behind them. And they've gone into the world of entrepreneurship because they found that corporate life didn't work for them. Because, again, they were often operating in a very patriarchal world, and they couldn't balance their lives with the work, and they couldn't make a difference. So they've gone into entrepreneurship, hoping that's going to give them something that they didn't have in their corporate career. And it starts well, and then they often end up facing even greater bias that is quite shocking, I think, to some women, because some of the stuff that women experience when they're dealing with investors, if you experience that in the corporate world, people will be up in an employment tribunal. Yeah. There is not enough accountability, there is not enough regulation, there is not enough measurement, there is not enough calling out of this stuff. And at times like this, where those people who don't come from that kind of privileged position are struggling even more we have to make the noise to sort this out. And it's tricky because investors, as long as they've got some pipeline coming to them, there's not really any massive motivation. Even though we hear the stats about female founders do perform better than the male founders, I think some of that is because those women have had to work so damned hard to get there that of course they're absolutely brilliant and of course they're delivering amazing results, right? So that's the counter side to it. But, there's some huge imbalances here, and we've got to be, you know all about this because this is your area of passion, isn't it? Yeah. We have to make a lot more noise, and we need to bring the investors into the conversation, bring all the male investors into that conversation. And I think, again, the sort of age difference, how we started at the beginning, what I'm definitely seeing is the younger generation of VCs And there's not so many young angel investors, unfortunately. There's still, the archetypal grey-haired guy that's, doing deals on the golf course, I'm afraid to say. But the younger VCs are amazing, and I've come across some fantastic younger men in that world who are just really trying to make a difference. We've got to bring the rest of them in.
And I suppose another thing that might be happening is we are starting to see the sort of almost the first generation of female founders who are backed and now actually becoming angels as well. And that probably makes it more likely that women are going to get invested in too. Hoping that's what we're seeing anyway.
Yeah, we're seeing a bit of that, but again, the dial is not really massively moving. Still only something like 14% of angel investors are women. They are out there, but they're not putting as much in. There's a lot happening in the industry to try and encourage that. Both the BVCA and the British Angel Association, big campaigns to try and get more women into angel investing and get those women to back women. That's the other thing. I think we've got to do that, because otherwise we're never going to cut through. But yeah, I'd love to say that my business will shut in 5 years' time because we have gender parity in the world of investment. I suspect that won't be the case. And I suspect I'll die still making these points.
We have another question from the audience.
Hi. It's kind of along the same lines of what you've been talking about. I'm a female founder, and I'm actually trying to raise at the moment. And one of the questions I have is, why do you think it's hard for women to raise money? From my point of view, I have a female health product, and so often I find approaching men, they don't get it, they think it's a waste of time, it's too small, not worth bothering with. So I tend to approach women with my product, but I just wondered from your point of view what you saw as the challenges as to why women aren't getting funded.
I think you've just answered your own question. You've just answered your question. And investors invest in things that they know, in people that they feel familiar with. You can understand that. And it is difficult, and we do speak a different language often from investors. So it is incredible, isn't it, that we still get that kind of, it's niche, like the baby market is niche, and you kind of go, excuse me, everybody in the world was a baby once. It's not niche. And women represent 51% of the population, so, it's crazy. But I think we're fighting against those conditioned beliefs that people have around what women are capable of. And what we have to do is just go out there and prove them wrong. That's what I think. And the more we prove them wrong, and the more great role models we have, and the more progressive investors that are seeing the potential in women, the better. We just have to lift each other up. So it is frustrating. You're right, going to investors that are more likely to get your product, whatever you're doing, makes a lot of sense. Push on an open door, not a closed one. But if all you can do is go to women investors, unfortunately, that's a very small part of the market still. So it's not very helpful, is it?
Yeah. I mean, you did kind of touch on the main reason, and I think it's funny when I started investing so I previously was a VC elsewhere. Then I we launched our own fund in 2019, and two of our first deals were Bubble, which is a childcare startup, and Peppy, which is a menopause startup. And those founders were having a really, really hard time fundraising. And I think without overstating our kind of impact on those companies, being able to find people who are advocates in the industry is it goes to your point earlier about how much incentive is there for people to call out bad behavior. That's the downside of how networked it is. The upside is when you do get someone who's an advocate, they can do a load for you, which I guess what you do, and what we try to do with our portfolio is we then need to advocate for with other people, because these partners, unfortunately, even when you find a female investor, very often she works for a male partner, and the male partner is someone who so it's not enough to convince that person. So you need to get those advocates and build it like a campaign, I guess.
And also, just put the word tech in front of it. If you call it femtech...
Yeah, menopause tech.
Exactly.
Yeah.
But there's a lot of, there's an interesting point there, which is about, it is easy to kind of say, well, they just don't get it. we have to work to help them get it, and we have to get creative around that, because investors do think with both their heads and their hearts. They do, the more data we can show them to convince them that this is not a niche market, the better we'll get on. But also connecting emotionally, because most men have women in their lives, daughters, wives, mothers, and if we can relate it back to them somehow. I mean, so my last business was a design your own shoe company, and I would go into investor meetings and they'd be like, well, do women really spend that much money on shoes? And I'd literally laugh in their face. And I'd say, okay, go and look in your wife's wardrobe. How many pairs of shoes does she have? And then they'd kind of go, oh, yeah. And it just helped, and it was a bit of humour, but it just made them stop and think. It's very, very easy to just dismiss female-focused products. We can't allow... I don't think we want to just kind of blame it on the investors all the time. Sometimes I think we're just going to go, right, how am I going to convince them?
Just got turned down by VC because the market size wasn't big enough. It was $1.3 billion US. And I'm kind of like, if that's not big enough, then how big does it need to be? It feels like often when you speak to investors, you get given excuses as opposed to the actual truth. And I spoke to another investor this morning, and he said, well, actually, if you multiply all of that up, you need to have like a $500 million size company for them to actually get enough return to pay back on their fund. And it's interesting how a lot of that stuff's not brought up. And so I guess that's another... But it's an investor thing, though, isn't it? How they don't tell you the real reason. They kind of tell you something else. It's quite frustrating.
I'll let you answer this in a minute, because I know you want to. I mean, my view is, investors are super busy. And as much as they'd love to be able to spend lots of time giving you feedback, they haven't got time. And they can't be bothered. And usually it's like, oh, come back when you've got more traction. And you're just like, steam coming out of your ears, right? Again, our job as founders is to dig underneath the reasons why. And not just take what they say at face value. And if you can get to that no in a meeting with them, you have an opportunity to explore that and really understand it and test them on it. The danger is if you sort of send your pitch deck out, you just get an email back saying, sorry, market's not big enough. You've not had the chance to have that conversation.
This was on the third meeting.
Yeah.
Wow.
After the third meeting, they told me this.
Okay. And did you ask them to kind of walk you through it and explain exactly?
We've got to
how
have
that
another
worked?
meeting to do that. We've got to arrange it. But interestingly enough, on the challenge people, I did challenge a VC because she told me that my product was going to get to a certain stage and then it would be a race to the bottom in terms of price. And I said, well, I'm not being funny, but how do you know that? And she said, I don't. I said, so therefore, how do you know that it's not worth backing me? She went, I don't. And I said, so why don't you back me? And she said, well, it's not just my decision. And there was no real rationale. It was just like, we don't agree with that. It's too risky, basically, was what it came down to. Your product's too risky, you're too risky, we don't see it.
That's what it is.
And how do you get over that barrier?
There are lots of things you can. There's lots of things you can do. There's no one answer to that, but it is really tough. And often, again, that judgment call they've made about you can be, honestly, just because you're a woman.
I mean, I think I remember seeing a statistic that was like the people who are best at raising equity finance are men who are good looking. So I think there are lots of different things that cut across it. Like if you have like a PhD or something, then that can often give you like an authority signal. Or if there are lots of different ways that you can like tap into, this is what I was looking for. But I think the good looking thing is like an interesting
and also in that same study, good looking women find it the hardest.
Yeah.
Interesting.
And I think around that again, it's just how we're hardwired. We're guys are kind of hardwired to look at an attractive woman and think of her in a certain way, and it's quite hard. There is lots of data on this stuff. I'm not just making it up. And the percentage of women who do experience kind of sexual harassment during the investment process is shockingly high. And again, in the corporate world, that wouldn't be allowed. We have to find a way to strip out the gender bias. We have to find a way. And when you see people doing it well, so for example, there's a small fund that's set up called Capital Pilot that go through a process where you apply. It's very data driven. and they have almost gender parity in the number of male, female founders in their fund, because they've stripped out that kind of the subjective judgment. You know, it can be done.
Patrick, what do you think might work? Like, what are you doing? Because you've managed to maybe accidentally invest in two sort of female-oriented.
Well, actually, that was my first point. Just to come back to the question first, that I guess the two things I was going to say was, one, I think VC trying to get to the number of why a VC has turned you down, I think is the right thing to do. But I would also say the way VCs are treated in the market is like not justified by and large. There are good VCs. Like I would aspire to be one of them, hopefully at some point. But by and large, it's like so luck driven. So that even when you get to like an honest answer, I would just think, okay, that's what they think, and try and move on. Because good investors will at least be humble enough to say, like, it's just my opinion. Like, we rarely invest. I need to build real conviction to invest. I just haven't built it here. Like, but you may well be right. That's like the right way to frame it. And I know not many people do it that way. The second thing is on outcome expectations is a really, really interesting point, and the fact it's not transparent is bad. I'm surprised there's not actually a blog where someone has tried to compile this with different funds, because it's really different. Like our fund, we try to be transparent and say every deal that we invest in needs to be able to the words you used, return the size of the fund, which means around 100 million revenue run rate a year. And that's kind of, a lot of funds are in that space, but like the big Series A funds, that's not enough now. Like you need to be, I think like Peanut is a good example that Index invested in, you even know Peanut. Like I'm sure the story they told is like, we can be a $10 billion company, because it's not enough to be a $1 billion company for their fund, because they've got whatever, multiple $700 million funds. So that kind of thinking, trying to get to that very early is probably a good, try to like tease that out of. I find that quite impressive when people ask me that in like an opening meeting. So I think like, oh shit, this person kind of was already trying to filter me out. So because you've got the big funds, then funds like us, then EIS funds in general don't need such a big return. Then angels often like deals that are good for angels are often not good for VCs, and that's absolutely like so. I'm surprised it's actually not that much. As it goes back to your point about incentives in the industry, like there's probably not the incentive for people to be that transparent, because funds are just happy if they're getting the deal flow. So
I think some founders, like just from doing our research, are like a little bit embarrassed to talk about the reasons that they haven't invested in. Like one founder I was talking to said, "Oh, I don't like talking about it because I don't want to be like, oh, poor me, poor little woman, I'm struggling to raise finance." Which, like, I think is part of the reason it's a bit opaque.
Yeah.
And but there's all sorts of other things. Like investors have got massive FOMO, right? Haven't they? So there's a lot about kind of building that kind of buzz and that awareness, and trading them off against each other, and kind of creating that demand for you, that sense of urgency. And when you're out there raising investment for the first time or even the second time, there's loads of you wouldn't necessarily know how to do those things. We go into it thinking, well, I need to raise money. Here's some investors. I'll just go and meet with them. It's a game, and it's a really opaque one, that's for sure. And it's an art and a science, and as you say, so much of it is luck. And you look at it, you kind of go, how did that guy raise that much money on that valuation off the back of that fag packet idea? He's probably a mate of the VC.
So
what are you gonna do?
Time for us to finish, but I want to close it on like a somewhat positive note. So if you just tell me, like each of you, going in order, one thing that you're excited about or optimistic about for the next year and the UK startup ecosystem. So.
Personally, there is for me, looking at this from a female founder's perspective, there is a lot more noise, there is a lot more buzz. I think female founders are recognising the challenges they face and are realising that they need to invest in their own skills and support to be able to get there. So I'm excited about that. And I am seeing more of a groundswell with the investment community waking up to the female founder piece. How much the dial will move, I don't know, but this isn't going away. Let's face it, it's not going away. And the more female entrepreneurs that are out there, making a noise, being successful, we will make sure that this isn't going to go away. So I'm kind of excited about that. Yeah.
Dan.
I guess I'm really excited about, the way that the ecosystem seems to be maturing, I guess. Like there's there's a lot more international interest in the UK and UK entrepreneurs. And that's just exciting. You know, there are some really amazing businesses. That's what makes working at Bowhurst so interesting, is kind of coming across these businesses every day and thinking, oh my goodness, I'd never thought of something like that, but isn't that a great business model or a great product or whatever it happens to be? And I think investors around the world are taking notice of that. I think that's a positive long-term trend.
So I think to return to a point I made earlier, the fact that, and I guess Julia, you echoed it, that there's an increasing focus on maybe matters or problems that matter, like the kind of tourists leave and people who really care and really have a mission are the ones who are staying, and I think that's really, really exciting. Like, there's a wall of capital for issues like climate change, and that is not going away. Like, that needs to be deployed, and that is really exciting, I think, because like, unfortunately, from a policy perspective, like, it doesn't look like that's going to lead to, like, that's not what we should be looking to for solutions. Like, I'm not in general a tech utopian, but in the climate space, like, we just have to get our heads down and basically go to work from an investment side and from the founder side, and that really excites me.
Can we have a huge round of applause for our panel tonight?